Good evening and welcome. I'm Divya Gopalakrishnan, and on behalf of CareEdge, I welcome you to our today's discussion on small finance banks geared up for growth. We sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today, Mr. Samit Ghose, Non-Executive Director and Chairman, Ujjivan Financial Service Limited, Mr. P. N. Vasudevan, MD and CEO, Equitas Small Finance Bank, and Mr. Sreemohan Yadav, who's an advisor in the financial service industry. This session will be moderated by Sudhakar Prakasam, Director at CareEdge Ratings. We will commence this session with a presentation by Ravi Nayak, Assistant Director, CareEdge Ratings. This will be followed by a panel discussion and a Q&A session. In case of queries, participants are requested to key in your panel. We will take up all your queries during our panel discussion session. Now may I invite Mr. Ravi to make his presentation, please.
Yeah, thanks Divya, and good afternoon everyone. Welcome to CareEdge Ratings webinar on Small Finance Bank Geared Up for Growth. Small Finance Bank journey has been anything but easy, starting from the demonetization after effects, NBFC crisis of 2018, private banks fiasco of 2020, and lastly COVID-19. The SFB industry has shown resilience and has been growing faster than the overall banking industry. COVID had resulted in deterioration of asset quality and profitability with reduction of capital cushions as SFBs continue to undertake rapid advances growth. With need for capital raising had emerged as a challenge to the growth momentum. Now with COVID scare behind us and improvement in economic landscape, there is a sharp improvement in asset quality and financial performance of SFBs. This has resulted in capturing investor interest for the sector, with some players raising equity through their maiden IPOs in FY23 and in current year as well. With better asset quality, improving profits and strengthening of capital position, the sector has strong growth potential. While organic growth continues, there have been announcements of a couple of mergers, largely for inorganic growth. Can you see the screen?
Continue, Ravi.
Yeah, major takeaways in this presentation are SFBs expanding their branches geographically across India, gain of market share in deposits with improvement in CASA, strong growth of advances and gain of market share with focus on non-microfinance loans, improvement in asset quality and decline in credit cost resulting in improved profitability. Capital challenges addressed, focus is now on growth. And last, mergers in the SFB industry. Let us look at the brief history of Small Finance Bank. The Union budget for FY15 cited the need for differentiated small banks that would help financial inclusion in India, following which the RBI published the draft guidelines for licensing of Small Finance Bank in July 2014. The objective of having SFBs was to further financial inclusion by providing savings vehicle to the underserved and unserved sections of the population and supply credit to small business units, small and marginal farmers, micro and small enterprises, and other unorganized sector entities through high technology, low cost operations. RBI in September 2015 doled out in principle approval to 10 applicants, out of which 8 were given to MFI NBFCs, with only exception being AU Small Finance Bank and Capital Small Finance Bank. The first SFB became operational in April 2016, and over the next 2 years, another 9 SFBs received final license. During FY21 and 22, 2 more SFBs were given licenses, taking the total number of SFBs to 12. In this slide, we see the key differentiators between SFB and universal bank. SFBs require lower minimum capital of 200 crores versus 500 crore for universal bank. SFBs have a requirement to meet a target of 75% towards priority sector loans instead of 40% for universal bank. higher CAR requirements at 15% against 11.5% for universal banks. 50% of total advances to be of ticket size of rupees 25 lakhs or below for SFBs. However, there is no such requirement for universal bank. SFBs are also required to open at least 25% of their branches in unbanked rural areas. There is no such restriction or requirement for universal banks. SFBs have been expanding their franchise continuously, and the number of branches grew at a CAGR of 29% since March 2018 to around 7,100 as on September 2023. The branches are well spread out all over India, with South India having the highest number of branches at 28%, followed by Western region contributing 20%. The strong focus on building liabilities franchise comparable to that of universal banks has resulted in deposits growing faster than the banking industry. The chart shows that deposits and advances of SFBs grew at a CAGR of 32% and 26% respectively during the period of FY20 to FY23, as against CAGR of 11% for both credit and deposit for the banking sector. At the bottom of the chart, we can see that in each year, the growth in advances and deposit was more than twice of the banking sector. The faster growth has helped SFBs gain market share in advances and deposits of the overall banking industry for the past few years. As most of the SFBs transition from being NBFC MFIs, major challenges faced by them in the initial years was mobilization of deposits. SFBs have done a commendable job on this front and built a good deposit base by setting up liabilities-focused branches. The left chart shows the improvement in CD ratio of SFB over a period of time. However, the banking industry CD ratio is much better than that of the SFBs. Coming to the right-hand side chart, although the CASA has improved slowly over the years, the CASA proportion still lags behind that of the universal bank. Raising low-cost deposits has been a challenge for the SFB industry and will take a long time to reach the level of private and public sector banks. It is worthwhile to know that although CASA proportion improved, the cost of deposits still continues to be high as compared to universal banks. Part of the issue is with the public perception carried on with the small finance bank tag. SFBs have been raising awareness by building its franchisee and increasing its visibility by opening new branches, giving attractive interest rates and through advertisements. We can see that in June 23, the CASA ratio has fallen faster for SFBs as compared to universal banks, indicating relatively lower stickiness of deposits. Here we can see as majority of SFBs transition from being microfinance institutions, the larger proportion of their loan book still continues to be skewed towards microfinance, which are entirely unsecured. There has been a gradual diversification of portfolios by SFBs with increasing share of secured products like home loans, LAP, mortgage loans, vehicle loans and gold loans, resulting in the share of microfinance to decline from 40% of advances as on March 2020 to 32% of advances as on March 2023. Excluding AU Small Finance Bank, the MFI exposure has reduced from 59% as on March 2020 to 51% as on March 2023. Going forward, we expect the share of microfinance loan to reduce even further. The chart on the left and right shows the yields on advances and cost of funds being significantly higher than that of the banking industry. The yields for FY24 is expected to increase slightly as majority of advances has already been repriced in FY23. The cost of deposits is expected to rise sharply in FY24 as majority of deposits will come for renewal. Another factor for increase is the cost of deposit is the shift from CASA to term deposits. As a result, NIM for FY24 is likely to compress slightly as compared to FY23. The regulatory requirement in terms of meeting PSL targets and restriction on ticket size results in limited flexibility to undertake large size funding to corporates. Therefore, business per branch for SFB is significantly lower than public and private banks. The slide on the right shows the cost to income ratio being higher due to low scale of operations, relatively higher investment in technology, and requirement of opening 25% of branches in unbanked rural areas. The business of SFBs are more branch dependent, and some SFBs also operate exclusive liability branches, leading to relatively higher cost to income ratio. The asset quality of all lenders were impacted during FY21 and 22 due to COVID-induced economic slowdown. SFBs, especially those with larger exposure to unsecured loan book, were more severely impacted due to exposure to relatively weaker borrower segment. SFBs saw a jump in their NPAs, requiring higher credit cost. With the impact of COVID subsiding and resumption of economic activity, the asset quality has improved during FY23 and continues in the FY24 as well. The impact of COVID peaked in FY22 when the credit cost was the highest, as SFBs undertook significant write-off with many posting losses. The situation improved in FY23 with all SFBs showing improved NIM due to rate hikes announced by RBI and return on total assets due to lower credit cost. The improvement continues even in the current year. This chart shows the median capitalization levels of small finance banks. The CAR cushion was depleted in FY22 due to losses and continued loan growth. In FY23, the capitalization levels have improved due to profitability returning and many SFBs raising equity. With significant capital in the kitty, SFBs have now the ability to grow their advance book even faster than previous years when there was a capital constraint. The regulations allow SFBs to raise Tier 2 capital to the extent of 100% of Tier 1 capital. However, at present, the proportion of Tier 2 capital is significantly lower for the SFB industry, indicating lower acceptance of their Tier 2 instruments. Many of the SFBs had planned to raise capital in FY22 and even filed DRHP, but were unable to raise equity within the expected timelines due to volatility in stock market and low investor appetite. All the listed SFBs were trading at or below their book value, with the exception of one non-MFI focused SFB. The market were valuing these stocks at book value without giving much weight to the growth potential. Fast forward 1 year, all of the SFBs have shown sharp recovery in asset quality and turned profitable due to improvement in economic environment. This has helped improve the investor sentiment as well. Many SFBs have been able to raise equity and few more are in the pipeline to raise funds. SFBs raised equity of 936 crore in FY22. This number had jumped to 2,956 and Tier 2 capital of 800 crore was raised in FY23. SFBs have raised 1,136 crore in H1 FY24 and almost 2,100 crore equity are expected to be raised during H2 FY24. The bullish stock market also helped get better valuation. From this slide, it can be seen that SFB's valuation was high in FY21 and then moderated in FY22 and was similar to private sector banks. With improvement in outlook, valuation of SFBs improved in FY23 and continues even in FY24 with the expectations of faster growth rate. There has been a couple of mergers announced in SFB industry with AU Small Finance Bank taking over Fincare Small Finance Bank to expand its product and geographical presence. Slice Group taking over a Northeast Small Finance Bank which was in need for capital and for inorganic growth. PMC Bank was acquired by Unity Small Finance Bank to protect the depositor base. We expect the SFB industry advances to grow around 23% for FY24, while many players might grow faster than that on an individual level, and the ROTA for industry is expected to improve to around 2.1% for FY24. Thanks everyone. This is all from my side. I now hand it over back to Divya to take it forward.
Thank you, Ravi. As conveyed earlier, attendees are requested to key in their questions, which we will take up during our panel discussion. Now, may I invite Mr. Sudhakar Prakasam to take over the session. Mr. Sudhakar Prakasam is a director and ratings head at Carriage Ratings. He has been working with Carriage for more than 15 years, having credit rating experience across corporate infrastructure and financial service sector. He is also around 2.5 years of experience in the banking sector, handling credit appraisal of small and mid-corporate credit in a large private sector bank. Sudhakar is qualified as an MBA from BIM Trichy. Over to you, sir.
Thank you, Divya. Good afternoon to all the esteemed panelists and participants. It's with a great pleasure that I extend a warm welcome to each and every one of you. Thank you, Ravi, for the informative presentation that set the stage for our discussion. As highlighted in the presentation, the journey and developments in small finance banking sector has been a topic of significant interest among various stakeholders, including investor community. And we hope that the knowledge shared today will be beneficial for all the participants. We are honored to have three highly esteemed panelists joining us today, and I express heartfelt gratitude to each of them for generously sparing their valuable time to contribute to this panel discussion. Before we proceed, it's important to reiterate that the views expressed by our esteemed panelists represent their individual perspectives and may not necessarily reflect the official views of the institution they are associated with. I would also like to quickly introduce our panel members to the webinar, and it's my privilege to briefly introduce each one of them. Our first panelist, Mr. Samit Ghose, is the Non-Executive Director and Chairman of Ujjivan Financial Services Limited. He founded the company in 2004 and served as its MD and CEO until January 31, 2017. Mr. Samit Ghose took charge as MD and CEO of Ujjivan Small Finance Bank Limited effective from February 1, 2017 and he retired on November 30, 2019. Prior to founding Ujjivan, Mr. Samit Ghose was a career banker with over 30 years of banking experience in India and overseas. Mr. Samit Ghose holds MBA degree from Wharton School of Business. He is also non-executive, non-independent director of Ujjivan Small Finance Bank Limited. Our next panelist, Mr. P.N. Vasudevan, is the MD and CEO of Equitas Small Finance Bank. He started Equitas in 2007 as a MFI, and later the group diversified into other retail lending, addressing the segment that are not effectively addressed by other mainstream lenders. The MFI was subsequently converted into a small finance bank. Prior to Equitas, he worked with Cholamandalam Investment and Company. He had commenced vehicle finance in Cholamandalam in the year 1991 and ran it till 2005. Mr. Vasudevan is basically a company secretary and a law graduate. Equitas Group is also very active on its CSR activities, and through its foundation it runs 8 schools in Tamil Nadu, exclusively catering to children from low-income families, providing them high-quality English medium education at very low fees. Our next panelist, Mr. Sreemohan Yadav, is an advisor in the financial services space with an experience of 29 years in Reserve Bank of India, wherein he worked in diverse areas including supervision, regulation, rural development, financial inclusion, HR, etc. He was closely associated with the SFBs, including during their formative years, and every year used to conduct roundtables for CEOs of these banks. He has dealt their licensing and holding structure related issues and was instrumental in extending certain relaxation to this segment. He also has a long experience of handling microfinance and priority sector related issue when he was a faculty member in College of Agricultural Banking, RBI, Pune. I extend warm welcome to all the participants who have decided the time to be part of this webinar. In case participants want to ask any questions on the presentation made or otherwise, they are requested to key in their question in the panel on the screen. Now we will begin our panel discussion and simultaneously take questions from the participants. Now my first question is to Mr. Samit. In the recent past, industry has witnessed two merger announcements, sir. How do you see the merger and acquisition in the small finance banking space, sir?
Well, as far as merger and acquisition is concerned, we may see some, because there are, if you look at the small finance banks, there are three which are large: AU, Equitas, Ujjivan, and then there are smaller microfinance institutions, smaller small finance banks, and some of them may go through some kind of a merger or acquisition. However, I think you would also see, just like AU has acquired, Fincare,
Yes.
I think some of the small finance banks also acquiring businesses going ahead, especially because, one of the things which the Reserve Bank requires us, who are purely microfinance institutions, to diversify our business and build up our secured business. And to that extent, we've been trying to build up our affordable housing, MSME, vehicle finance, etc. But to add impetus to that growth, some of us may look to acquire some businesses in the secured business area.
Okay, sir. Now I would get the perspective of Mr. Yes, sir, Mr. Vasudev.
You went off air for some time.
Okay, sir. Sir, given the recent merger announcements, do you see the consolidation happening in the small finance banking industry? What is your view on that?
See, the SFBs, if you go back to the origin, RBI guidelines, which started the whole concept of SFB, it was to promote financial inclusion in the country. And that's why, we have 75% PSL targets and 50% of loans should be less than 25 lakhs, etc., etc. So if you look at the financial exclusion situation or scenario in the country today,
Yes,
as per various NSSO survey and other government data, anywhere around 35 to 40 lakh crores is the total unmet credit demand from the informal economy segment. So if you look at 35 to 40 lakh crores of unmet demand, and if you say that SOBs are, conceived for the purpose of financial inclusion, then rather than talking of consolidation, we should be talking of more and more SOBs coming into the space so that we can really, make a serious dent in terms of financial exclusion, right? In fact, I was giving some presentation in the RBI Staff College some time back. So I was showing a calculation that if all the current 12 SFBs grow at 25% per annum continuously for many years, it will take us about 65 years for the SFBs to meet this 35 lakh crore unmet credit demand. So that's the scenario. So my feeling is that, if at all any consolidation happens, it may be very, very, individual related issues. It's not a sectoral related issue. See, when you normally have a consolidation at a sector level, is when demand dries up, there's not enough opportunity and there are too many players, then the smaller players want to exit and the larger players are happy to acquire them and reduce the level of competition, etc. But in SFB space, that's not the scenario. I mean, the unmet demand is so high that, we need to grow at 25% for the next 65 years if we need to meet the unmet demand. So M&A will not be driven by sectoral related issues. It will be, if at all it happens, it will be purely because of some individual, entity-based, scenarios.
Okay. So, rather than shrinkage of number of SFBs through consolidation, it's time for have many more SFBs which would be helping the RBI to achieve financial inclusion. Thank you, sir. Thanks for that view. This question is to Mr. Sreemohan. Sir, one of the objectives of RBI setting SFB category was to further financial inclusion by way of providing access to credit and access to other banking products. So, what is your view on the industry's performance in terms of achieving the set objectives?
So definitely they have achieved the objectives. If you see the PSL target, which is around 80-85%, then you also see the MSME maybe 28-30%, weaker section 44%. For a scheduled commercial bank target is 10, but these people have done very good performance in weaker section. Then whether it is for a small and agricultural farmer also 25% as against the target of 18%. The data which I collected is from the annual report of RBI. The recent performance may be much better also. So they have achieved the objective. They have reached to small and marginal farmer. They have reached to micro entrepreneurs, and they have the branches across India, not only in the metropolitan cities and urban areas, but also in small places. And because they have been found when technology has taken off, so there is no constraint on their reaching in the remotest area. So that the financial inclusion part also, if you see, they have done very well. So there is no doubt that they have not achieved their objectives.
Okay, sir. And this question is to Mr. Samit Ghose. Sir, majority of regulations related to SFBs were formed in the initial years in 2014. Do you see there is a need to overhaul this regulation? If so, what would be your major suggestions?
See, I think one of the things which, as Mr. Yadav mentioned, and so is the opinion, fortunately for us, with most of the people in RBI, because I had recently had some interaction with seniors in IIM Bangalore, seniors from RBI. The small finance banks have definitely been successful in the terms of the objectives which the RBI set. And this compares with the previous not so successful attempts with RRBs, LABs and payment banks, etc.
Okay.
So, and obviously we are also growing substantially, and there is, talk about why don't we apply for a universal bank license, etc. Now, given that these are specialized institutions, I don't know how much, and successful. I don't know to what extent RBI will sort of agree to that. But one of the things which we would certainly like, especially as our, the small finance banks which have grown substantially and has shown a very good track record, is to reduce our capital adequacy requirement from 15% and bring it closer to the universal bank. And we can take, not only credit risk, we can take the operational risk and whatever risks are involved. And because that will enable us to more efficiently use our capital. So that is something which if RBI, based on the performance of small finance banks individually, could ease up, that would be a good thing.
Okay, sir. Instantly, if you look at in the presentation, in terms of capital adequacy levels, all of the banks are well capitalized. But what we see is many of them have not been utilizing the Tier 2 capital to the full extent. Mr. Vasudev, how do you see this scenario? There is a flexibility in terms of using Tier 2 capital, but many of the SFBs are not using to the fullest extent. How do you see this situations?
Yeah, so Tier 2 is something that we will use when two things happen. One, when it is required, and two is that when the cost is attractive. See, most of us historically have had a higher level of capital adequacy on Tier 1 itself. And then there's a regulatory requirement also, for SOBs to list within 3 years of starting operations. Right.
Okay.
And so we had to list, and which means that there is some amount of capital that we raised. And some of us have the holding company structure, and the whole core generally held a large percentage of the bank. It was 100% to start with. And so even after we completed the listing and complied with that portion, then the next rule of SEBI came in, which is that the public holding should be at least 25%. So again, we had to raise fresh capital to meet the 25% public holding norms also. So people have been raising equity for not just the growth purpose, but for some of the regulatory compliance purpose also. And so most of us are sitting on a high level of tier 1 capital. So tier 2 is something that we will probably look at when we reasonably exhaust the tier 1 capital by growing. And then finally we need to raise capital only for the purpose of supporting growth. And that's the time when probably people will start looking at tier 2, of course subject to cost, being in line.
Okay, sir. Sir, Mr. Samit Ghose has to...
I just want to add that...
Yes, sir. Please continue.
The cost, as Vasu has, raised this, tier 2 corporate capital is expensive, So we don't want to go into an expensive source of capital,
Okay. Fine, sir. Sir, I understand you have some exigencies you have to log off. In case you wish to log off, you can log off. Sir, thanks for joining to the webinar, sir.
I'll stay another 5 minutes and then log out because it's
okay, sir. Thank you, sir.
Mr. Yadav and Vasu, haven't seen them for a long time.
Nice, sir. Okay. This question is Mr. Sriram. Sir, do you see any incentives for other set of lenders in the, say, cooperative banks applying for SFB license? Mr. Sreemohan, what is your view on this?
The cooperative sector converting into SFB, which first was this UP bank, right?
Okay.
Which has set up a SFB. And there is a lower requirement. Actually, RBI has given a lot of incentive as compared to a normal MFI to convert into SFB or an NBFC to convert in SFB. If a cooperative bank want to convert, the capital requirement is half of that.
Okay.
Actually, much lesser, and half of that is to be reached within a certain time period. That relaxation also has been given. Because you know that the governance is much better in SFB as compared to cooperatives for the reasons already well known. And they get access to so many other facilities, so many other relaxations which otherwise not available to cooperative banks. But so far only one has come, and maybe one or two may be in the pipeline. I'm not aware, but incentives are there. Incentives already RBI has built in.
Okay. This question is to Mr. Samit Ghose. Sir, in the last few years, SFBs have traveled a long way in terms of achieving certain metrics in terms of CASA proportion, CD ratio. Given that they have been under a transition period and also seen a lot of external shock, we understand a lot of interests are there for the existing SFBs to convert into universal bank. What is the advantage you see moving into universal bank, and is the time right to move to the next level, sir?
So, this I mentioned earlier, there's been a lot of items in the press about SFBs going for a universal bank license, but I'm not sure because, we are maybe victims of our success, because SFBs have been successful in terms of achieving the goals which RBI had set. Whether RBI will be very keen to change that, I'm not sure. But as I mentioned, if the RBI progressively relaxes the capital adequacy requirement, taking into account that we of all the risks which we have, not just the credit risk. That is something, at least personally, I would like to see because that will be a much more efficient way we can use our capital, because today we are hampered by that compared to universal banks.
Okay, okay, sir. Sir, this question is to Mr. Vasudevan. Over the years, yes, sir.
Yeah, thank you. Goodbye. Sorry.
Thanks for joining the webinar, sir.
Thank you.
Thank you. Yes, sir. Sir, over the years we have seen SFBs have improved the CASA ratio. However, still there is a large gap exists between the universal banks and the small finance bank. How do you see the SFB's ability to bridge that gap? Will they be able to reach that level of universal banks?
So if you look at SFBs and if you look at the two sides of the balance sheet, on the liability and on the asset side, on the asset side, largely our customers are from the informal economy borrowers, small borrowers, people who are typically from the low income segments. Now that segment of people do not really have much of excess surplus cash to place as a deposit in the bank. Okay. So when we want to raise money deposit, we have to go to the middle and upper middle income category of people, which is where the surplus cash is available. And when we go there, we are actually head on in competition with all the banks in the country, every single bank in the country, starting from State Bank of India onwards. We are in competition with them. And so how do we meet that competition, and how do we win a depositor from, let's say, State Bank or from a HDFC Bank or so, whatever it is, some of those large banks. So it's going to be a struggle to raise this low cost deposit. The TD that we have raised is also at a higher cost compared to the large banks. Almost all the SFBs we are paying anywhere between 1% to 1.5% higher on the TD rates compared to the large banks. And when it comes to savings also, we are paying, we pay 7% interest for most of the slabs on savings. There's some slabs which are lower, but most of the slabs go at 7%. So we are able to get money only because of the fact that we are offering a higher interest rate as on date. And if you look at it from a depositor perspective, the day that we reduce our interest rate, will this money go away from the bank and go to the larger banks where the difference in rates is not much? So the way we can bite that bullet will be only when we are able to offer the same level of services as well as products to a depositor that the large banks offer. So many of the SFBs have done well in terms of certain level of services, our physical service at a branch or our digital service through the IBMB apps and all that are maybe generally not that bad, maybe reasonably comparable to any bank in the country. So that way services we are, I think, more or less in line. But when you come to products for a deposit customer, they need to have products where the account has to become used for that product, like a personal loan or a credit card or a car loan or a home loan or any of these consumer loans. If they consume from an SFB, then they will start paying the EMI through that account, and so that account will get more and more used. And when they start using it, they will start funding it, and so the account becomes sticky, the relation becomes sticky, and at some point you drop your interest rate, the money just doesn't move away. So that brings us to the question of what level of products are we able to offer from the SFB segment. And currently almost all the SFBs we do not offer any of these products because the interest rates on that in the market is so low that most of us are not able to compete at that rate. So we are not able to offer those kind of products. And so for some time, the SFBs will pay higher rates and it will be a uphill struggle to keep improving your CASA ratio. But over time, as SFBs, mature, stabilize, and are able to attract deposits without too much of differential interest rates, that's the time you will see that we can offer more loan products and get a better relationship with the depositors, and through that process, reduce our cost of funds and improve the low cost deposit ratio over a period of time.
Okay. So for SFBs to compete with the universal banks, the way forward is to offer a bouquet of products so that you are able to retain the customer, the stickiness increases. Thanks for that view, sir. This question is to Mr. Sreemohan. Sir, in banking parlance, when we say CASA, it denotes low-cost deposits. But in case of SFBs, while they have been successful in terms of improving CASA ratio, so still they are